So this is going to be lesson 1.5. It's not quite long enough to be a whole lesson, so lesson 2 is going to come out in the future, and that's going to be candlesticks, and that's based off of the Candlestick Bible and a few other things that I've seen play out over my time in the markets. So let's just have a look at how the fundamentals move the market. So this is going to be how news affects the market. So obviously the markets move on fundamental news. It is driven by central banks and governments. There's other things like monetary policy, GDP, and all that stuff that will move it, and it is hideously complex. Most of us will never fully understand it, and the good thing is we don't need to. However, it is important to know and understand that they exist and they can help us decipher a direction for a pair long term. So just remember that long term, because you cannot time these markets. But if you know long term where price is probably going to head, you can keep your average pricing and follow it. Right, let's have a look at what I mean with not trying to time the market. So as you can see, this is the daily chart, and right now if we look over here, I'm in 2017. So if you actually shoot a line across, maybe more in the middle, I'll do it more in the middle of the chart. So if we shoot a line across the middle of the chart, you can see that all the way in 2024 we're still pretty much at the same price. Right, so that's just what it does. Price is going to, I'll draw a line. Fuck, that's a shocking line. I'll draw a line across, alright? Price is going to bounce, come back to its mean, go below it, come back to its mean, come above it, bounce around a bit, come back to its mean, go below it, come back to its mean, above, come back to its mean, below, come back to its mean. So as you can see, price is stretching away but then coming back, stretching away and then coming back. That's just what it does. If you have a really long move against you like this one, guess what? Price eventually comes back. So once you know that price comes back to its mean, that's just what it always does. That's just every pair. You can go and look at this. This is the daily chart. Price will always come back to its mean. So this is where I get into where I say not trying to time the market. I'll get a really good example. Let's just say, here's a decent example. Alright, so we've mechanically seen that price is stretched right here. So right here it's tapped the 30 level. So price is stretched down. So since it's stretched down, we're expecting it to come up. However, we're not trying to time this. That's where most traders lose. They try and time these markets. So where were we? All the way up here. I mean, you probably would have got out with that little move up. But let's just say you didn't. So you enter a long position here. Because it's stretched, you're expecting price to come up. And it doesn't. It moves against you even more. So it's moved against you, but you haven't placed a stop loss. If you placed a stop loss, you would have lost money. And you would have been like, shit, it's probably going to come up even more now. So you might add another buy. These are kind of shit examples because you would have got out both these times. But for whatever reason, you don't get out and you get stuck in these positions. You place another buy and you put a stop loss because you're expecting it to come up. And your stop loss gets hit again. So instead, let's just say we add buys at every level we see, or every certain space between. So we put a spacer between our orders, and we just keep adding until the expected move that we're expecting long term to happen happens. So we keep adding positions, and as you can see, price eventually does have that snapback that we're expecting. So since we've averaged into the market, if we only placed our first position, our average price would be at this line here. We haven't used stop losses, so we haven't actually lost any money. We're entering with such small positions that every time we add, it just brings our average price with us. So since we've added 1, 2, 3, 4, 5 positions in the market, our average price would be right in the middle. So it would actually be on this trade here if they're spaced all the same and we use the same lot size. Now, price does eventually have that snapback we're expecting, so yes, we can make a little profit even though we were wrong 4 times. if we slightly increase our lot size every trade, our average price could actually be all the way down here with us. So we're keeping our average price close to where the actual price is at the time. So when we do have that snapback that we're expecting, we can get in break even and then profit very quickly. So you're not trying to time the market, and by doing this you're going to lose less trades. So we can kind of predict how the market will move, but nobody can predict when it's going to move. So if you're trying to trade and predict when the market's going to move, you're probably using a stop loss. Long-term price, you know for a fact it's probably going to come down, for example, but you got a stop loss at your highs. Price is going to hit it and then eventually come down. So you're trying to time the market, and this is why most traders fail. You're going to constantly get stopped out. So most traders fail because they concentrate on the timing of the entry and not the actual trade idea or expected move long term. So if you concentrate on the direction where we are likely going and why, the timing is less important. So the market moves on news, and we know this because the majority of the time the market will move up and down in a range, will consolidate or slowly trend while waiting for news to make a big move. So price kind of sticks around and waits until news does come out, because then these bankers know sort of where to take their position. So it's going to wait, and then when news comes out, it's either going to go down or up. And it can follow these for days or weeks to come, especially when they're red folders like this. So obviously red folder being the strongest or most impactful news that comes out, followed by orange and then yellow. But I actually filter out yellow because they're not too important. So sometimes news can do nothing or it can go crazy. And the reason why is because if you look over here, you can see we have the previous results, whatever we're looking at, we have the forecast, and then the actual. So if the actual comes out what has been forecasted, price has probably already slowly made its way to where it's forecast. If price comes out not what's forecast, that's what's going to cause these massive moves in a certain direction. So that's why you see these huge moves at news. It's when the forecast is different to what the actual comes out. So these are the main factors that drive price. We have interest rates, inflation, GDP, and unemployment. Now, if you have a basic understanding of these things, it kind of does make sense as to why it would affect price. So if you have a look at unemployment, if people are unemployed in that country, they're not earning money, so they're not going to spend any money, and that money that they're not spending isn't going back into that supply. And they're also going to be taking money from the government being on unemployment, so that's bad for a currency if there's unemployment. You also have GDP, so if you are a manufacturing country, or say a mineral country like Australia, and you're getting lots of coal and resources out of your country, that's going to raise your economy, and it's going to attract investment from other countries because you're making all this money which is going to be going into the Australian economy. Then there's a few other things like interest rates and inflation. So high interest rates would be good because investors can earn better returns just for holding in that currency. So there's many factors, but this is just the basics. There is other things like war and that which can definitely affect price. So let's carry on. These are the two websites I get my news from. Number one being Forex Factory. So this is the one I showed before with the red folders, the orange folders, and it shows the impact news might have based on the color of the folder. Forex Factory also gives you a forecast of the news and previous data, just over here. So what if you don't know what this news is and how it's going to affect the price? So you can click on the actual folder and it'll give you a description of what the news means and how it's going to affect the price. So you click it and it's going to give you a little bit of a description here. So most of the time you don't actually know what the actual result is going to be, and that's why news is unpredictable and dangerous to trade. Also, another thing which brokers do is they will spread price like crazy just before news comes out. And that is because if price is just sort of sitting in a range, and some idiot, some people do this, what they'll do is they'll maximum leverage their account and expect, sort of gamble, that price is going to go in one direction really high. So the brokers, by spreading price, they're going to reduce their losses if someone does get a good run. But most of the time, people lose trading like this because you get wicked out. And I would not recommend trading news at all. So news can get extremely complex. And if you don't have a finance degree, there's probably no point in following it, because banks pay analysts six-figure salaries to give them scorecards. So these guys that have gone and got a financial degree and gone to uni, they get a job at Wall Street, for example, and they will give the traders a long-term estimate of where price is going to go. And what they do is they look at all these figures over here, and they add them together, minus them, do what they got to do, and they make a scorecard which is going to give them a long-term bias of where price is going to go. So this is another reason why these banks and institutions do not use stop losses, because if they know, because of their scorecards that they've been given, that price is eventually going to reach this high, and it's here at the moment, price could bounce down, come up, down, and it's going to do what it's got to do until it reaches up there. So if you were sitting at home and you took a buy right here because you think it's going to come up for whatever reason, and you set a little stop loss here expecting price to come up, and you get stopped out, and then the move that you were expecting anyways does eventually happen, but you've been stopped out because you used a stop loss, which banks and institutions do not use. Not one of them. Think about it. If they're trading with billions of dollars, do you think they're going to set a stop loss to get fucking hit and lose millions and millions of dollars potentially? No. What they're going to do is they're going to average in and keep their risk close and reduce risk by averaging in. We'll get into that later, but this is just going to be simply about news. So this is how they look at it. These analysts will make scorecards, all right? So this is to simplify Forex Factory, and it kind of uses a traffic light system. So as you can see, the actual came out less than what was forecast. So it's red, and since it's red, it's bad for the euro. If it were to be green, it'd be good for the euro. So you can just look at this, and it's a quick, easy way to look at it. If it's red, it's bad. If it's green, it's good. Second place I get my news from is Financial Juice, and this will give you slightly more data, but it's more after the event has happened. You do also have a few talking heads on there which will talk and sort of give you ideas. So for example, in April last year, a lot of the time you would see Bank of Japan on here, and Bank of Japan would be saying shit like, we're not happy with where our price is, so we're probably going to do an intervention soon. They don't explicitly say they're going to do an intervention, but they'll start jumping up and down and saying they're not happy with where price is, blah, 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 blah. So it can kind of give you a background idea, but it also gives you news like this. You can see there's a crisis and threatens to strike oil factories. So that can also give you an indication of what's going on. You also see Trump talking here, and then also general news coming out, the same as Forex Factory. So it's good to look at both. So I'm not an economist, and so my general rule of thumb because of this is to just stay out of news. And it's probably a good rule for anyone. You don't want to be in news when it comes out, because you get huge moves like this. And if I'm sitting in $250 profit, for example, I'd like to just get out with my little profit that I have, rather than try and sit in it, because it can turn into zero very quickly. So I just kind of try and avoid news as much as I can. So hopefully this lesson wasn't too long, but what you've hopefully learned is that news is unpredictable, and trading it is pretty much gambling. So I try and avoid it at all costs. So you'd also know that news is used to drive price in a direction. So if you see price sort of consolidating around for a few days. It's probably waiting for news to come out. You also know that when price comes out with an actual being completely different from its forecast, it's going to move, and it's going to move hard in either direction. And you don't know what it's going to be because you don't know what news is going to come out. So you also know where to get your news from. Number one, we had forexfactory.com, and number two, we had Financial Juice. So news can start moves that you can get stuck in if you are dollar cost averaging. So say you're in shorts because price is stretched up far in one direction. You got your orders in, and you're just expecting price to have a pullback. But you have news come out which is extremely positive for the currency you're trading, and it's going to push price even further against you. So even if you come and you're in like a little bit of profit, or you maybe break even, I'd try and get out of that position in case news does push it up. So if you're currently sitting with a trade in profit and news is coming out, I don't know, I usually just shut it off because I do not want to be in that trade. And it sort of helps manage your risk as well. So hopefully you enjoyed this lesson. It was a bit of a shorter one, but as I said, this is more like lesson 1.5. It doesn't quite constitute a whole lesson, as this is just sort of how news moves the markets. So thanks again, and we'll see you for the next one, candlesticks.